Okay, so in this lesson we're going to learn about Japanese candlesticks and multiple time frames, right? Time frames. So, because they go hand in hand. All right, so when you're looking at a price chart, the up and down, right? The up and down is price, right? You see prices up here is at $1.21, down here it's $1.14, right? Up and down is price. Left and right is time, right? Over time, right? Pretty much makes sense, right? Time, price. Now, within what you're looking at when you look at a chart is these lines. What are these lines? These are called Japanese candlesticks, right? And what they do is they give you a bunch of data just by looking at the chart. So what a candlestick is it represents a period of time, right? So this candlestick is a period of time, this candle, this candle, this candle. How much time is each of these candlesticks? Well, that depends on your time frame that you're on. We're currently on the 4-hour chart. So each of these candlesticks represents 4 hours of time, okay? So this candlestick took 4 hours to complete. This candlestick took 4 hours to complete. This one. All of these took 4 hours each. So if you go from this point, this is Friday, right? September 15th. If you go all the way to here, this is August 29th. Excuse me. August 29th back here, right? And all the days in between that, because each of these represents 4 hours. So if you put 6 of these together, that would represent one day, right? 6 of these 4-hour candlesticks is 24 hours. That would be one day. Well, guess what? We have a daily chart. Go to the 1-day chart. Now, what this has done it's compressed all those 4-hour candles into groups of 6, basically, making one candle to represent the day. So those 6 candles at the end on the 4-hour chart, these 6 candles, 1, 2, 3, 4, 5, 6, have been compressed into one candle on the daily chart. And it makes this. And so on and so forth. So now, September 15th is here. August 29th is right here. See how short of a distance that is now? Because all those candles have been compressed. All that data has been compressed. See, now if you go back that same amount of distance, kind of, September 15th is here. All the way back here is July 30th, right? So now we're looking at a longer frame of time because each of these represents one day. Okay? And then, so that holds true for all of these different time frames, right? So the 4-hour chart can be broken down too. This candle here is made up of 4 1-hour candles. So if you go to the 1-hour chart, boom. Now you have 1, 2, 3, 4. These 4 candles made up that last 4-hour candle. And each of these 1-hour candles has candles inside of it. Right? 1 hour, if you go to the 30-minute chart, it'll be 2 candles making up a 1-hour candle. If you go to the 5-minute chart, it'll be, I can't even count right now, 12. It'll be 12 of these 5-minute candles making up a 1-hour chart, or 1-hour candle, right? And so on and so forth. So each time frame plays a role, right? And of course, the larger time frames always take precedence. The larger time frames are the stronger time frames, right? The smaller time frames just make up the larger time frames, right? Now, what are these little lines versus the boxes and the colors and all that? Okay, well, let's talk about it. All right, so we're on a 1-hour chart. What this means is, we'll look at this candle right here. What this means is during this hour, right, this is 7 o'clock on the 15th. During this hour from 7 o'clock to 8 o'clock, this candle price went from here, $1.1958, to here, $1.1944. So price moved down about 14 pips in that hour. Okay, that's what the body, this is called a body, right? So let me draw it out. We have, here's a candlestick. We'll make it red. That means it went down, okay? And then we'll make another candlestick. We'll make that one green. Okay. And then we'll talk about the bodies first. So what the body means is, if the candlestick is green, that means there's an open, right? So there's an open. I know I'm all over the place. All right, so there's the opening price, closing price, right? And then if it's red, the closing price would be at the top, because that means that price moved down during that period of time, that hour. These are hourly candlesticks. During this hour, price moved down, so the opening price would be at the top. Price opened there and closed here, right? So price moved up during this hour, and price moved down during this hour. Okay. Now, what did the little lines on the end mean? Those are called wicks. And what a wick means, sometimes they're short, sometimes they're long, right? What a wick means is that, let's imagine at, let's imagine this is a 12 o'clock candle. So from 12 to 1 o'clock, this is the candle. At 12 o'clock, this candle opened here, right? When this candle first opened at 12, this is what it looked like. This is exactly what it looked like when it first opened at 12 o'clock. It looked just like this, right? It probably wasn't green or red. It was nothing until price started moving. So what these lines mean is that during that hour, that's where price traveled to, right? So during that hour, price could do anything like this. Price is doing this, going up, down, maybe. And what these lines mean is basically it's like footprints. That means that at some point during that hour, price came down here, but it came back up, right? And sometime during that hour, price came all the way up here, but it came back down. And eventually, at the end of the hour, so this is fluctuating, at the end of the hour, price closed right there. And that is how you get a candle body and the wicks. Excuse me. Need some water. Okay, so that's what this means, that price opened at the bottom at the beginning of the hour. It moved up and down. It fluctuated, right? And then it closed at the end of the hour here. Now this red candlestick, what happened with this red candlestick, right? When this red candlestick opened, it opened up here, because that was the last price from the green candle. This was the beginning of the new hour. This is what it looks like. And then price maybe started going like this. Now if price was moving up like this, what color would it be? It'd be green. But then once it gets back down to here, then it would turn red. And then price probably fluctuated like this, came back down to this area down here, right? And then closed, boom, right there. And that's how you get that candle. So that's how candlesticks are formed, right? So look at this crazy looking candle right here. I can guarantee you this is probably during news, right, or something where there's a lot of volatility in the market. Price opened here, and during this hour, it went up and down all this area. And then at the end of the hour, before, right when it closed, it was pretty much right back where it started. Okay. Next candle opened here, fluctuated, closed here. Next candle opened here, fluctuated, closed here. Next candle opened here, fluctuated, closed higher. That's why it's green. Next candle opened here, fluctuated, closed lower, red. Opened here, went all the way up, didn't fluctuate much, closed up there. See? So if you follow the candles, now you can see what's happening. So price is basically just moving up and down and doing something called trending. Okay? We'll talk about trends and trend analysis in part 3 for the basic technical analysis. But right now we're still in part 2, just going over basic theory and definitions. Okay? So that is Japanese candlesticks and time frames. And as you know, there's all these different time frames, all the way from month to week, day, and all that means is the time frame that you're on means that each candle represents that amount of time. So on the monthly chart, you go to a monthly chart, each of these candlesticks took a month to complete. 1 month. So this chart goes all the way back. Look at this. This chart goes all the way back to 2000, 1997, 94, and part of 93. Right? So this chart here begins at May 1993. Right? That's crazy. I mean, imagine being a Forex trader for this long and you've actually seen all of this happen over the years. It's crazy. And this is where we're at, this little speck in time. But that can be all the way zoomed into by going to a smaller chart. Go to a 5-minute chart, and all that space we just looked at, this is a 5-minute chart. Bam. Now the whole screen, instead of taking up years, we're looking at September 15th, 11:55 at night. In the beginning of this chart here, or not the beginning, but I mean on the beginning of the screen here, is the same day at 2 p.m. or 2 a.m. I'm sorry, 2 a.m. and 11 p.m., almost midnight. So this is a whole day, basically. So all of this is compressed into one daily candle. So if you look, this day started 15th. This day started here, went up, and came back down halfway and closed here. So what do you think that daily candle looks like? That daily candle is going to look something like this. Price started down here. It went up, right? Went up and then closed about halfway. So the candle is going to look something like that. May have a little wick at the bottom, but the daily candle for this day is going to look something like this. So let's go take a look and see. Oops. Let's go take a look and see what that daily candle looks like for the 15th. Delete all this stuff I drew in. And lo and behold, look at that. There's our candle. Just like I said. Price started down here. Alright. It came down a little bit, I guess, during that time period, went up, and then came back down. And that's how you get this candle there. Alright, so hopefully that made sense. And that would be Japanese candlesticks and time frames.